We have a very special guest joining us. He's a regular with us at News9. Mohit Gang, the co-founder and CEO of Moneyfront, is here with us to help us make sense of the markets this Monday morning. Good morning, Mohit. Thank you for being here with us on News9. What are you making of the mood check today? Because yesterday, in fact, not yesterday, we had a 3-day weekend, but prior to that, last week, we saw 2 sessions of healthy gains, and that momentum seems to be continuing this Monday morning as well.
Oh, absolutely, Kartik. Morning. And look, I think markets have taken a note of whatever has happened globally. I think the announcements on tariffs have pretty much kind of settled now that no further announcements or no further surprises are in for the offing. And it's just between US and China to come on the table and settle down things. Otherwise, I think the world or at large is settling to newer realities. From an India perspective, look, I think we've been telling that the macro on India is improving. You have the inflation print, which is coming at an all-time low. You have an RBI which has changed its stance from neutral to accommodative,
Right.
which means a lot. And you would see further rate cuts coming in. You have the banking sector, which is flush with liquidity and where the results are pouring in and the margins are improving and everything is looking quite neat and clean out there, right? And you have even in a slowing world, Kartik, I think the bigger moot point is that India would still stand out with a growth which is somewhere around 6% or 6.5% of GDP, right? That's not a mean number by anything. And plus, if the China plus one story really plays out, because you will see incrementally the newer allocation from FIIs and FPIs, if they have to figure out any destination after 6 months, Kartik,
Yeah.
what that destination could be, right? It can't be China for sure, because I think the global money will be really scared to enter China with the
Right.
kind of war it is in with the US. And US per se is in doldrums in terms of policy, right? So the stance is not clear. So if the FIIs have to find a new den for their money, then it would have to be it would have to be India, right?
Right.
So my sense is in a 6 months to a year, when the world settles down to newer reality, I think India will emerge extremely positive from that outcome. And we have to just bide out our time in next 6 months, see where the trade balances settle in, and then perhaps get ready and set for a new encouraging rally in the market.
Right. Let's talk a few sectors, Mohit, should we? Let's begin first with the IT sector, and the commentary which is coming after the disclosure of results for Q4 has been a little tepid. I don't think there seems to be as much of optimism, and at best perhaps just cautious optimism, given the R word in the US, and that could be recession. Now, we really don't know with this delay of 90 days, is recession going to hit US this year? Is it going to hit US next year? Is US going to escape recession and just have a soft landing? And that is a word that we've been using consistently since COVID. But the IT sector is directly linked to the mood in the US, and the mood in the US is fairly volatile. What do you make of a long-term investor betting on India's IT story?
Look, Karthik, I think honestly, IT is a tricky sector to call out right now. I would
Okay.
not enter the space right now, given the kind of headwinds it's facing. It's not
Right.
just the US market entering into recession. I think globe at large, when things are looking uncertain for businesses, the first spending cut which comes out is always the IT cut, right? And that's where it's all emanating from. I think the world is not very certain which way it's heading, and perhaps IT will take a brunt of it. Second, the rate cut scenario in US is not looking extremely positive. It's a dilly dally between the Fed and the US government right now. They are also in a tussle node, so you don't know whether you will see incremental rate cuts coming in, which in itself is not great for an IT sector.
Right.
And third is the kind of job slashes and job cuts which we would perhaps see with the advent of AI all across, right? So I think overall, it's a wait and watch kind of a scenario for the IT sector. It's got beaten down heavily off late. So maybe perhaps, yes, you would see some dead cat bounce kind of stuff out there happening, but I don't think so. It's a sector to enter right now. I would stay away from it as of now.
All right, stay away from the banking sector. And of course, we don't know which way Jerome Powell's career could swing, given the stark warnings that Donald Trump has been giving him. What happens in case Donald Trump was to go ahead and sack Jerome Powell, Mohit?
Look, I think honestly, markets won't like these kind of chairs getting sagged, honestly, but I think markets find its way. So my sense is the newer guy who comes in perhaps will come in with a mandate of reducing rates further, which which to me looks like a market positive. Honestly, if rates get slashed, I think that's positive for equities, that's positive for global equities per se.
Uh-huh.
And if that were to happen, I think markets would remain sanguine from that perspective. Though, as I said, it's never good that the government interferes in the working of a central bank. But yeah, I think that's par for the course in the world which we are living in.
All right, that definitely is par for the course. I want to talk to you about the consumer non-durable space, the FMCG stocks, and they seem to be a little under pressure this morning, Mohit. In fact, HUL is down about 0.6%, ITC is down about 1% in early trade. Even Tata Consumer is down almost 1%, Nestle is down 0.6%. What are you making of the consumption stocks, the FMCG stocks? Why are they're supposed to be our last layer of defense, if not the first layer of defense, and the defensive stocks are actually dwindling quite aggressively this morning.
Yeah. Look, I think when your overall market is looking positive and looking good, and the high beta stocks are doing good, and the high beta sectors are doing good, that's when I think the defensive sectors perhaps take a pause. But from 1 year kind of a perspective, honestly, I think. That would be my second or third bet in the market, given that two or three scenarios will play out this year, Kartik. I think number one scenario which will play out is that the largesse with the finance minister has doled out to the consumption sector per se by virtue of tax cuts. I think that will all play out in this financial year. So you would see perhaps higher spendings going out in the market from next quarter onwards, and that should augur well for the sector. Second is, I think, the monsoon. The forecast from IMD and other agencies is pretty positive. It's 105% of normal monsoon, so it looks pretty good as of now. And if that were again to play out, I think we are in for for a good harvest for the consumption sector at large. Right, in consumption, you can always though call out that there are few pockets which are very aggressively valued in terms of valuations, and there are few pockets which might still look attractive. So you will have to do some bottom fishing out there. But overall, my sense is the pack looks good, given that the world at large is kind of a little scared of equities right now. I think as a sector, they should do good for this year.
All right. And what do you make of the headline number coming on Sensex? Well, I'm seeing on a chart right now, Sensex is what, nearing the 80,000 levels, Mohit? Are we confident that 80,000 is at least one peak that we could potentially scale today? And then what becomes the new resistance for Sensex from here?
Oh, absolutely. 80,000 on Sensex and 24,000 on Nifty is just there, Karthik. It's just
Right.
there for taking. I think we have, in a whiff, we were at 21,800 on Nifty, and in a whiff, we are back to 24,000. And that's the cost of staying out of market, or that's the cost of actually taking a call on markets. If there are any long-term investors out there, I think it's a good lesson for them that never to take timing calls on market, because markets can prove you wrong in a jiffy, right? No one was betting on markets rebounding so fast, so quick to these levels, but that's where it is. And as I said, the Indian macro, Karthik, is looking extremely positive, and there will be no other destination for global money to land in next 6 months to a year but India.
Absolutely. Well, I think everybody seems to be bullish on India, and of course, Indian bulls also seem to be bullish now on the Indian markets, with the Sensex nearing the 80,000 levels and the Nifty 50 nearing the 24,000 levels. Well, that is a level that we could see in trade today. But Mohit, coming back to the fundamental question, you're talking about India's macros being stable and India's fundamentals being strong. But then we also have stories like Gensol, which erupt out of nowhere and sort of mar the mood of investors. So I mean, we've been hearing about the froth in small caps. We've been hearing about staying away from risky stocks. And in a market like this, do you think it makes sense to just stick with the Nifty 50, Sensex 30, passive investing? Can't go wrong with that.
Karthik, two parts to your question. One is the evolution of capital markets in any developing economy will always inevitably go through these cycles. You will keep figuring out bad fishes in the pond, and that's where the regulatory framework comes into play. I'm glad that these things are getting called out more often than not. And it's also a lesson for investors to learn as to how to evaluate companies, how to evaluate balance sheets, and how to actually focus more on promoters and the quality of management.
Right.
Right. So I think these are all part of evolutionary setup in the market. The second part, yes, right now perhaps taking shelter in the large caps is the best possible thing. You look at the rally in the large caps, you look at the large banks, you look at the large names in the market, they're all inching up like anything, right? So if you really want to be safe, and want to take a healthy up move right now. I think large caps, blue chips is the best possible thing. And to play that, yes, I firmly believe that a passive call on buying the index itself is a great call to take.
All right, so buying the index is a great call. As of now, well, we don't know how things evolve from here, but I can't let you go without asking this very basic question, this innate question that every Indian is definitely obsessed with, if not the central banks and many other institutional investors, and that is the yellow metal gold. What is going on with gold? How hot will it get? And do you expect in perhaps a few days from now, if not a few hours from now, we could see gold hitting that 1 lakh rupees per 10 grams? And if so, what does the investor do? Buy more, hold on, sell? What do you do?
That's the toughest one, Karthik, you've asked me. Honestly, I'll be hurting the
I'm sorry, I
sentiments.
hate to do that to you on a Monday morning, Mohit, but I think we definitely need your view on this.
One thing which it's extremely difficult to call out, I think, right now is the yellow metal. Though I think the rally has been overdone. Honestly, it's too steep a rally to be considered true, but that's happening in front of all of us, and it's more because the global scenario is extremely fragile right now, right?
Right.
The uncertainty which is looming all over. The moment you have a clear direction, Karthik, I think the moment you have a clear settlement of the trade and everything, that these tariffs and everything on the table, my sense is gold should take a pause. Look, I understand that the central banks are buying more. I understand that the Chinese are asking their insurance companies to buy more. I understand there are statements coming from Trump. I understand that this is the safest possible heaven. I understand that the value of gold has been eternal, perennial, everything. I get all that. There are a lot many positive things which I can keep rattling off.
Yeah.
And if you were to ask me to give a negative right now, I perhaps don't have any. But I just accept that it's too good a rally to be true,
Could the
right?
negative be
So
perhaps holding more gold at this point? Is that a negative? Is that something that investors should be wary of?
I think you should be cautious of entering gold at these levels. If I were to put out my clear view on this one,
Yeah.
entering at these levels, my sense, and then expecting you to make similar kind of returns will be firing in the air. I don't think so. Anyone should be doing that. If you're sitting already on a stockpile of gold or digital or physical,
Yeah.
yes, by all means, feel richer and feel good about it. But I don't think so. It's a level to enter any further now. I
All
I,
right.
I
So
honestly think there has to be a pause to this rally pretty
right,
soon.
right. And gold ETF as part of your investment sort of, asset allocation split, gold ETF a preferred option as opposed to buying jewelry where you pay making charges and GST and a lot of other
Oh,
to the
100%.
jeweler?
100% goes without saying. It was SGB previously. Since the time SGBs have stopped now, I think the only second best option which is available to investors is the digital way of buying gold, which is through gold ETFs and gold fund of funds. I think that's a fantastic way because you can do your SIPs there. You can continue to buy. You can continue to buy in a hassle-free, paperless format. Plus, you get the printed price of the gold which is out there on the screen, and it's very easy to liquidate at any point in time. So I think goes without saying that for people who wish to invest as part of asset allocation, buying gold ETFs or gold FOFs is the way to go for.
Right. Well, we will leave it at that this morning, Mohit Gang. Always a pleasure having you right here with us on Morning Brief at 9, but we will let you go for now.